Hi, this is James Stroke and welcome to Westpac London's end of day wrap for Tuesday, November the 15th. Well, Europe's very much the main story of the day again. In fact, Italy probably the main one to focus on. I'll just run through a couple of developments there and then look at the quite extensive range of economic data that came out today, which also had quite an impact on markets. Okay, the problem is in Italy, basically, the new Prime Minister Monti, he seems to be having trouble getting the various political parties in Italy to agree to form the new interim coalition government. So just a few days into his tenure, it looks like it's not going to be a smooth road towards Italy implementing the austerity measures and hopefully maintaining access to financial markets. On that point, bond yields in Italy, 10-year bond yields back up at 7% today, and there's been speculation rife that you could see Italian government bond yields, bonds downgraded by the ratings agencies at some point, possibly to junk status, given that at the yields they're currently at, 10-year bond yields in particular, other countries with those sorts of yields are already rated as junk. And now the added complication though is the European Commission is currently considering introducing, I'll have to read this to you, suspending sovereign rating changes during crises. So basically silencing, as it were, the ratings agencies. In the same way that many European governments have banned short selling, or naked short selling at least, they're trying to figure out ways to at least lessen the downside risks confronting the sovereign space. So all of that has meant that European markets are pretty negative today. There's renewed concerns about the banking system in Italy, certainly concerns about the imminent recession that we think Italy is about to enter, if it's not there already. On that front, we had European or Euroland advanced GDP numbers for the third quarter, showed 0.2% growth in Q3, but that's probably going to be the last quarter of growth, well, on our forecasts for the next year or so. We're looking for a 0.6% contraction in European or Euroland economic output in the year of 2012. Lots of other data today. The US news was reasonable. Retail sales in October posted a decent gain. They're up 0.5% in line with our forecast. But what was really important was that the number when you take out autos and gasoline posted a healthy 0.7% rise, and that followed a decent September number and upward revisions to that number in July and August, which meant that we had a decent third quarter in terms of core retail spending, and that momentum seems to have continued so far into October. Now it remains to be seen whether the American economic consensus decides that this is the beginning of the sustained recovery and that the Fed will be tightening again in a year's time, like they did when there was a run of good data in early 2010 and again in early 2011. On those occasions, Fed tightening was talked about and priced in. Subsequently, of course, the data weakened sharply again, and in fact the Fed put in place QE2 later in 2010 and more recently Operation Twist this year in response to the renewed weakening in the data. At Westpac, our sense is we probably will see further renewed weakening in the data. There are plenty of headwinds out there, and of course the new one, or the increasing one, is the one from across the Atlantic, the European sovereign and banking crisis, which is certainly pushing Europe into recession and will have a downward drag on other parts of the economy. I won't run through all the data today in that much detail. We had a fall in the PPI in October in the US, but a stronger New York factory Fed index. The German ZEW survey fell sharply again. It's down 9 months running in terms of the outlook. The level of this index is pretty much running where it was at the depths of the recession back in 2 or 3 years ago now. So analysts feel now that the depth of the likely recession in Europe is what they thought the previous recession was going to be in terms of its depth. Although, of course, they were wrong last time. The recession actually was a lot deeper last time than they expected. So that's it mainly on the data today, except in the UK we had the CPI. The inflation rate fell from 5.2% to 5%, which probably means that September saw the peak at 5.2, and we're now just beginning the long downturn in inflation as VAT hikes drop out, the output gap imparts downward pressure on inflation, energy and utility bill increases eventually drop out as well. And on the Bank of England's forecast, inflation will be back at 2% by the end of next year, heading into 2013. There'll be a lot more, of course, from the Bank of England in their quarterly inflation report tomorrow and press conference with Mervyn King, the Governor. Right, so that's it on the data front today. On markets, we had we have the Dow up about 1/3% at the moment. It's 6 o'clock in London. That the US markets did open weaker, dragged down by the European news, but the healthier retail numbers and the New York Fed index pushed futures up at least, and that seems to have dominated the session more recently. Now that Europe's closed, the US investors are just focusing on themselves now. And we've got a bit of a gain there, up 1/3, as I said, 12,1119. FTSE in London, pretty much unchanged on the day. The French market down 1.9%, and the German market down 0.9%. Okay, the Aussie dollar is at 1.017 at the moment against the US dollar, the middle of the 1 cent range that it traded today in London. And in commodity markets, oil's up 1%, $99.06 a barrel. We've got copper prices up 0.5% today, and gold is up 0.1%. It's $1,780 an ounce. A couple of things to watch for in Australia. We at Westpac we're putting out our leading index, and we also get Q3 or third quarter wages data for Australia, and plenty of US data tomorrow night as well to watch for. Okay, that's it for me. Back tomorrow.